Good morning, everyone. My name is Brian Hendricks, and I wanted to welcome you to our Building Blocks of Success workshop entitled Accounting Practices and Financial Reporting. I also wanted to thank those of you here who were involved with or attended our annual Today's Challenge, Tomorrow's Reward conference last week. It was a big success based on the feedback I've heard. And if you weren't there, we encourage you to do all you can to be there next year. It's a great opportunity to network and learn best practices. We are delighted to have as our presenters today our management supportive services consultants for IDOT Districts 1, 2, and 3, Ms. Michelle Ringgold, who's the president and CEO of Ringgold Financial Management, and Olga De La Rosa, who works with Michelle at Ringgold. And we're delighted to have you both here and for all you do. So thanks for everything and take it away.
Thank you, Brian. As Brian said, welcome to today's workshop. Today is being presented by Michelle Ringgold, President and CEO of Ringgold Financial Management. So just some housekeeping rules. Make sure you mute yourself and keep your video off. And all questions will need to be entered in the Q&A. Please don't enter them in the chat. We will answer questions throughout the presentation, or if not, we'll answer them at the end of the presentation. And just a reminder, this session will be recorded and provided to firms in a follow-up email, and then along with any other helpful resources we need to share. There also may be a short survey following the presentation. Please let us know how we can help improve and any ideas for future workshops. So today's agenda, we've gone over introductions, our housekeeping. We're going to go over IDOT's goals, talk to you guys about supportive services and resources. We'll jump into our presentation for accounting practices, financial reporting, Q&A, and then some closing remarks. So IDOT's goals. IDOT's goal is to provide assistance to DBE firms and individuals interested in doing business with the department in ways that ensure equity, access, and transparency. IDOT, in accordance with the federal guidelines, strives to facilitate and implement programs that can help current and future business partners open the door to doing business with IDOT. The department works towards this goal in a variety of ways, most notably through the tools available at our resource centers. The supportive services program that is executed through our partnerships with consultants who provide management and technical supportive services assistance, and corresponding supportive services programs that fall under the umbrella supportive services program. This support is provided at no charge to IDOT's DBE firms, to firms seeking IDOT DBE certification, to Illinois UCP DBE certified firms who have an IDOT contract, and to prime contractors doing business with IDOT. The Illinois Department of Transportation Office of Business and Work Diversity, Brian Hendricks is a Policy and Supportive Services Unit Manager. His email is there. Learn and grow. While opportunities may increase for certified DBEs, it is not guaranteed. Free programs and resources support firms' goals at all phases of growth. Develop technical and management skills, navigate operational expenses, connect with established firms, discover the best practices for successful work with IDOT. Visit idot.illinois.gov to find your nearest resource center. Resource centers. Each of IDOT's 9 districts offer essential equipment and resources to conduct business with the agency. These resource centers contain computer access, internet, scanner, copier, printer access, staff assistance, including support for DBE applicants. The resource centers are free of charge to all firms seeking to do business with IDOT. You can scan the QR code on the screen or visit idot.illinois.gov for a list of locations in your district. Compliance officers. Contact compliance officers are accountable for EEO and labor compliance on state and federally funded projects. They ensure contractor compliance with state, federal laws and regulations governing the EEO and labor compliance and DBE programs. Visit idot.illinois.gov and search for contract compliance officer to find a local officer in your district. Technical and management assistance. Ongoing assistance helps DBEs maintain a competitive edge. This assistance is complementary to IDOT's DBE firms or to firms certified in the Illinois UCP that are bidding on IDOT contracts. These services include, on the technical side, estimating and bidding, equipment and resources, project site inspection, pre-qualification. Management includes bookkeeping systems and credit restoration, bonding and insurance, business and strategic plans, and marketing. Our supportive service consultants. So for certification, we have a consultant in District 1 through 3, Theo Joyner from Ralph G. Moore and Associates. You'll see that the consultant's information is there, their telephone number and their email, so you can reach them if you need any assistance with any of these services. Districts 4 through 6, Melissa Hamilton from Synergetic Solutions. Districts 7 through 9, Mark Vaughn from FV Consulting. Management services for Districts 1 through 3, Michelle Ringgold from Ringgold Financial, and you can also reach me for Districts 1 through 3 for management services. Melissa Hamilton for Districts 4 through 6 with Synergetic Solutions. Districts 7 through 9, Mark Vaughn for FV Consulting. And for technical services, you can, for Districts 1 through 9, you can reach Ron Brown from Gonzalez Companies. Workshops and events. The Bureau of Small Business Enterprises brings innovative events to the public with these goals in mind. Share skills to become more competitive on IDOT projects, help individuals and businesses work with IDOT and form strategic partnerships, encourage sharing of best practices, policy and procedure changes. Each district hosts events year-round to help firms do their best work with IDOT. You can visit bit.ly DBE workshops. So as Brian stated, we just had our today's challenge, tomorrow's reward, TCTR, February 21st. It was a great conference. Now we're going to go over the available programs. The DBE reimbursement program. IDOT offers 50% reimbursement to qualifying firms in select categories while funds are available. These include association organization membership costs, training or certification class, website capability statement or logo, and much more. You can contact the Bureau of Small Business Enterprises to discuss criteria for these limited time funds. Business Development Program. Qualifying DBEs can receive firm-specific guidance to propel their growth in the transportation industry. Full business evaluation, and so they'll receive a full business evaluation and analysis, tailored training that may be eligible for reimbursement, personalized recommendations to maintain competitiveness, how to apply. Enrollment opens once per year. 15 firms are accepted annually. Applications for 2024 to open soon. You can visit idot.illinois.gov for more details. Mobilization payments. To account for preparatory work and operations necessary for the movement of subcontractor personnel, equipment, supplies, and incidentals to the project site, and for all other work or operations that must be performed or cost incurred when beginning work, the contractor shall make a mobilization payment to each subcontractor. The mobilization payment must be made at least 7 days prior to the subcontractor starting work. The mobilization payment to the subcontractor is an advance payment of the reported amount of the subcontract and is not a payment in addition to the amount of the subcontract. Therefore, the amount of the advance payment will be deducted from future progress payments. The amount paid is a percentage of the value of the subcontract shown in the table below. So you can take a look at this table as an example. HCCTP program. The Highway Construction Careers Training Program boosts participation of diverse individuals in the industry and on IDOT's highway construction projects. Illinois Community College partners offer training in industry, trade, and life skills. Some of these skills and industry trades are OSHA 10 certification, welding, forklift operation, first aid, CPR, AED, math for the trades, introduction to electrical, plumbing, sheet metal, carpentry, introduction to tools, and more. Although employment is not guaranteed, however, participants do receive job placement assistance. And here are 4 reasons why HCCTP graduates make ideal hires. They are well trained to fulfill entry-level roles, professional talent with diverse perspectives, eligible for work on IDOT project sites, reimbursement via IDOT training special provisions, TPG. Who can apply for the HCCTP program? Eligibility is open to women, minority groups, and other persons from historically underutilized populations. They must be at least 18 years old, have a high school diploma GED, a valid driver's license, and ability to pass a drug screening. So before we jump into our presentation, we're just going to talk a little bit about Ringgold. Ringgold is led by our managing partner and president, Michelle Ringgold. We are an Illinois licensed CPA and management advisory firm established in 2005. We are certified as a DBE firm. We combine 3 major disciplines: auditing and accounting, regulatory compliance, risk management, and management advisory, to offer turnkey solutions that maximize cost savings and efficiencies. We can deliver under one umbrella the highest quality of our clients by using available resources to provide timely, effective solutions. To reinforce these services, we offer a variety of training options on a customized basis. Ringgold has a proven track record of providing effective management supportive services and has helped secure millions of banking and bonding lines of credits to DBE firms, as well as supporting DBE firms in providing accounting and administrative support that can help them sustain and grow their business. Our staff includes a talented group of licensed and certified public accountants, certified project managers, and business professionals. With them, we provide DBE managed supportive services in districts 1 through 3. Services provided under DBE management supportive services include QuickBooks and other accounting system support, business plan preparation, cash flow analysis, bonding and financing assistance, credit restoration, and they just added marketing and much more. So contact our office for more information. And then just as a reminder, as we start, please remember to enter your questions in the Q&A, keep yourself muted and your camera off. So we will go ahead and get started. And I'd like to introduce to you guys Michelle Ringgold.
Thank you, Olga. I was going to turn on my camera just for a quick second. I know it takes up bandwidth, and it's advised not to. I really appreciate everyone's time today, and we also would like to, thank IDOT for actually having this platform available. I think it's important for small businesses to take advantage of the resources and what IDOT has to offer. So, Brian, we really thank you and your team. As indicated, I'm Michelle Ringgold. I'm the president and CEO, managing partner of Ringgold, and we're a licensed CPA firm. We've been supporting IDOT under this contract, supplying supportive service management to DBE firms for well over 6 years now, and I'm happy to have you guys here today. We're going to be talking about the importance of financial statements and understanding. At the end of the day, information dictates behavior, and business owners really need to make sure that they have accurate and timely financial statements. So the first slide here is just a summary of the importance of financial statements. And financial statements, number one, they provide a formal record of your financial activities. And as a business owner, your financial statements offer valuable information about your company's overall financial positions. It also focuses on areas that, you have financial strengths, or areas where there's weaknesses and gaps that you need to work on. So it really helps you, if done correctly, understand where you're at financially. Financial statements are important, obviously, to tax authority like the IRS and various state agencies. It's important that your financial statement information is correct in efforts to ensure that your tax returns are prepared correctly. A company's financial conditions are a major concern to investors and creditors to ensure that your credit worthiness. So it's important for your financial statements to present an accurate status of your organization. As capital providers and investors, they rely on your financial statements in order to make decisions on if they're going to lend to you or not. And then really, as an executive or an owner, the information dictates behavior, and you as an owner need to get timely financial statements so you understand where your business, what they're doing currently, how you're compared to estimates, and what you need to do moving forward. So to help financial statements, a big piece of this is the role of a certified public accountant. And I just want to briefly state that, you know, there are two different types of certified public accountants. You can be a certified public accountant, which means that you pass the exam, but you also, to be a licensed CPA, there's some experience requirements that's required. And the only reason why I mention that is because if you're just a certified, or not just, but a certified CPA, cannot represent you if you're ever going through an audit with the IRS. The only three professionals that can represent you is a licensed, a certified public accountant, not just a certified public accountant, a licensed attorney, and then an enrolled agent. And then also when we're rendering opinions on financial statements, the only individuals that can do a review level financial statement or an audit level financial statement is a certified public accountant that's licensed. No other professional can issue an opinion on your financial statements at those levels. So the role of a CPA is to provide reasonable insurance for financial reporting and disclosure. So, you know, providing that insurance level that the financial statements are free of errors and misstatements. CPAs also provide accounting information system management, whether that's helping you set up your system, helping you secure the financing, doing operational analysis, helping you develop internal controls and budgets and forecasting that business owners need in efforts to help them plan and strategize. We also can help with compensation assessments, obviously tax-paying services, strategic and planning, as well as helping you minimize your tax liability is critical and often provided by CPAs. Next slide. The importance of using a CPA is a lot of times, you know, your bank or your bonding company requires CPA level financial statements. We can help you set up your system in alignment with your business to ensure that the financial statements are meeting your objectives. You know, how you set up a construction firm versus a manufacturing firm or a professional service firm is different. And I can't tell you how many small firms we inherit their systems and you know, they're not really set up to meet their objectives. It's important that you hire a CPA that really understands your industry, the construction industry, or whether that's manufacturing or professional services. There are, you know, unique things that are related to each industry. There are unique tax laws that you want to make sure that your CPA understands in efforts to make sure you're maximizing and minimizing taxes. You also want to make sure that your financial statement is in accordance with GAAP. Most banks and bonding companies want to see a GAAP prepared financial statement, and the acronym stands for Generally Accepted Accounting Principles, and it's a standard that CPAs must follow. Next slide. The importance of an accounting system. It is very important that you have an accounting system set up, whether that's QuickBooks or any other sophisticated system that you choose to use. QuickBooks does do the job. But the bottom line is an accounting information system. It helps you provide timely data. It measures efficiencies and effectiveness of the business operations and financial information. Having your QuickBooks or software set up, not only does it give you actual real-time data if you're putting information in correctly, but it helps provide historical data if you're bidding projects and then, 10 years later you have another project that's similar, just so you can understand, maybe looking at that historical data to help you bid current data. It certainly helps summarize and provide financial information on the transactions. It assists you with sending out uniform and acceptable financial statements to your external users, whether that's the bank, whether that's your insurance agent, whether that's other investors. It's important that you have a system that is set up properly that can issue you internal financial statements. And at the end of the day, it really is a tool guide to help management achieve their goals and objectives specifically related to their business. Next slide. Understanding the basics of when you're setting up your accounting system is very important. Regardless of what system you use, system setup is important to meet your objectives. So if you're in the construction business, you may want to make sure that your software has the ability to job cost, that your software has the ability to accrue for insurance and union if you are a construction firm. If you're a business professional service firm, you may want to make sure that your business has the ability to track time hourly and be able to import that into your billing with your customers. So really just understanding, first of all, what your industry needs are and ensuring that your system is set up to meet those needs. Maintaining an accurate chart of accounts. Not only understanding, the chart of accounts is the brains and the system, I would say, behind how your financial statements are reported. So making sure that your assets are classified properly, and we'll go into details of looking at the different sets of financial statements later on in the presentation. But truly the chart of accounts and how you set it up is how accurate your financial statements are going to be. Making sure that if I have expenses, I separate not only the expenses directly related to my sales, which is considered cost of goods or cost of sales, but also segregating that G&A so I truly can understand and run different ratios like break-even analysis and things like that is important. Identifying posting periods is important. What we call that in accounting is matching principle. So if all of your cost is associated with one period, you want to make sure those sales are matched up as well. So if I had $100,000 in sales, I want to make sure that all the costs related with those sales, let's say those sales were in January, will be posted in January so I have accurate period financials as well. You should really, best practices, always do your bank reconciliations on a monthly basis. I can't tell you how many small firms we pick up. They're using QuickBooks, but they're not keeping track of their reconciliations and ensuring that transactions are in timely. I started off by saying that, information is very important, but it needs to be accurate and it needs to be timely because it dictates behavior. And if the information is incorrect or not timely, that can be a bad thing and result in bad decisions. It's important to understand debt and, your debits and credit balances and how they affect the general ledger. And, our firm under IDOT can provide all kind of training so that you as owners, or if you want to send your accountants or controllers over for training, we can help them, with some of the best practices and take a look at your setups to ensure that you're meeting your objectives. If you have a need for project costing or costing, it's important that that's set up. A lot of businesses, it's great to have financial statements on an overall basis, but having project costing and job costing, now I can drill down and see what jobs are profitable, what jobs are not, and do further analysis to ensure that I'm meeting my customers' expectations and budgets as well. Setting up and maintaining accurate and reliable account payable balances, ensuring that you're getting all your vendors in the system, ensuring that, you know, the invoices are in, that your payment terms are in properly, so it will help you when it's time to create cash flow analysis and projections. You understand what your liabilities are. Setting up and maintaining accurate accounts receivable. I know IDOT doesn't take out retention, but some government agencies do take out retention or retainage, which is typically they'll hold 10% if you're performing on a large job until the job is substantially complete, and sometimes that's defined as 90%. It's important if you're in the construction world or any type of industry where retention is held, that your system is set up, and we do have the ability in QuickBooks and many other softwares to set that up properly. Your payroll parameters and setting up configurations if you need help with that, whether you're a union shop or you just want to make sure that all of your costs associated with payroll is hitting your projects and things like that. We know, regardless of what industry, I may pay someone $40 an hour, but after I add in the union benefits and workers' comp benefits and insurance and those other fringe benefits, that $40 can easily jump up to $65 or whatever. And if I don't have that configured properly in my system and I go into my job costing or project costing, it could be very misleading. So it's important that you get those all those costs associated with payroll configured. Whether you're using an ADP system or you're using an internal system, it's important that those things are set up properly. Next slide. Understanding financial statements. There's two types of financial statements that we're going to be covering here. One is the accrual method, which is really the best practice and desired method. If you don't take anything else away from the next two slides, it's really just understanding the difference between an accrual-based and for cash-based financial statement. So accrual-based is a method of accounting when economic activities or financial events are considered. It determines at which point expenses and revenues are recognized according to the revenue recognition principle. Incurred expenses are matched to related revenue under the matching principles and is required by U.S. GAAP. So that's the formal definition. In really simplistic terms, accrual is I recognize my sales at the time that I performed the services or delivered the product. So if I'm in the service industry and I perform services, my contract is $10,000 a month for every month that I perform the services. So for the month of February, I would book the $10,000. I may not get paid from my client for 30 days or 45 days, but I want to make sure that I book the services at the time that I've either performed the services or delivered my product. On the expense side, for an accrual method, I don't record it at the time that I'm paying the expense, but I record it at the time that the expense has been incurred. If I'm using a subcontractor for the month of January to help me perform the services, I bill my customer for $100,000. That subcontractor bills me for $30,000. Even though I may not pay them until I get paid, I am still under the accrual method, putting those expenses into my accounting system at the time that the expense has been incurred. So revenue at the time that I performed the service or delivered it, and expenses are recorded at the time that they're incurred, not necessarily at the time that I'm paying it. And this is the generally accepted GAAP principle. So typically this is what banks and bonding companies request. Next slide. On a cash method of financial statements, basically the cash method of accounting is based on the cash flow of financial events. You're recognizing revenue when cash is received and expenses when cash is paid out. It does not recognize promised cash payments or a promise to pay or a promise to collect. And the cash method is not compliant with GAAP, but there are especially smaller businesses where the bank will accept a cash basis financial statement. So the biggest thing is understanding that sales are not recorded until they're collected, and expenses are not recorded until they're paid. So just think about that for a minute. Am I doing myself a disjustice if I bill my customer $100,000 in sales for work that I've collected, but I don't book it until I actually collect it from the client? So although that, is a form of financial statements, it's not GAAP, and you really are doing yourself a disjustice, because if I do a year-end financial statement at December 31st, 2023, and it's on a cash basis, I can show that I've collected $1 million in sales, but I still have $500,000 in sales out there that's still owed to me. So if I flip that to an accrual base, instead of the financial statement showing $1 million in sales, it would be showing $1 million, 1.5 million in sales on the accrual basis. And of course, the flip side of that is accruing the expenses at the same time. Okay, I'm going to pause for a second to see if there's any questions, and if not, I can move on. No questions? Okay, next slide.
Yeah, no questions. Just checking over both the chat and the Q&A just in case, but yes, no questions.
Okay, thank you. You can go to the next slide. Okay. So there are 3 levels of financial statements that a CPA firm presents, and want to explain those to you, because a lot of times, even when you're responding to an RFP, a request for proposal, even bankers, a lot of times they use the term audit, audited financial statements loosely, and sometimes an audited financial statement is not necessarily required. A compilation is the lowest level, a review is medium, and an audit is the highest. Just to give you an idea, we're considered a smaller to medium-sized firm. A compilation from a price point can start at our firm anywhere from $2,500 up to about $5,000. A review at our firm can start anywhere from about $6,500 up to about $12,000. And an audit can go start with $12,500 all the way up to, depending on the complexity, $50,000. So there is a big difference, and as an owner, you really should understand and make sure that you're required to do an audit or review, because if from a especially on RFPs, we get a lot of requests where, hey, I need audited financial statements for an RFP. Well, do you want to have to pay $12,000 if a compilation will do the job for $2,500? So it's important that you really do understand the difference. Next slide. So a compilation. A compilation engagement is the lowest level of services that a CPA can provide. American Institute of Certified Public Accountant Code of Professional Conduct Standards do not require the accountant to perform any procedures to verify or corroborate the financial statements information provided by the client. On the other hand, the accountant must address significant questions that arise in the course of the compilation engagement if the accountant has reason to believe the information supplied by the client is inaccurate, incomplete, or otherwise unsatisfactory. The accountant is required to observe, revise, or correct information before reporting on the financial statement. So what this means in just really simplistic terms is it is the lowest level of financial statements. We really do not offer any insurance on the accuracy of the financial statements. But what we do is make sure that the financial statements are are presented in accordance to GAAP, meaning that the assets are where the assets need to be, the liabilities are where the liabilities need to be. If you're showing liability, but then you're not showing interest expense, we may ask a question about that. But at the end of the day, we really don't verify the validity of if those numbers are correct. But a lot of times banks do ask for CPA prepared financial statements that are compiled level, and that is the lowest level. Next slide. The second level financial statements are what we call the review engagement. So it's reviewed level financial statements. And it does require all the procedures for a compilation engagement, but it also includes procedures that enable the CPA to provide limited assurance on the financial statements. Inquiries of management, analytical procedures. Inquiries should relate to the accounting practices and principles used by the company, recording and accumulating financial information, actions taken at meetings or of the stockholders or board of directors. And so the biggest difference between a compilation and a review, a lot of times those that are in like maybe a construction industry where you're trying to get bonding, a lot of times the bonding agent will not accept a compiled level financial statements. They want at least a review. I know that SBA has some points that when you're over a certain threshold, they require a reviewed level financial statement. And then if you get to a certain level, they require an audit level. But the biggest takeaway here is that we don't just take the financial statements and ensure that they're in accordance with GAAP. We actually perform analytical procedures. We do comparison of your current period to prior period. So if you have job costing and we see that you typically run at a 20% profit margin and now you're running at a 10% profit margin, we want to make sure that that's accurate and want to understand what's happening. We also look at things like if I have fixed assets on my balance sheet, then I'm expecting to have a depreciation schedule and make sure that that's correct. And we do a lot of walkthroughs and inquiries of management before we render an opinion on the reviewed financial statements to ensure that the financial statements are accurate at a limited basis. Next slide. Our highest level of reporting is what we call an audit. In an audit engagement, it is the highest level of assurance on the financial statements. Auditors are required to obtain reasonable assurance that the financial statements are not materially misstated due to fraud. Some of the important auditing procedures consist of consideration and evaluation of internal controls. So for example, if you have one person actually putting all the transactions in, processing the checks, doing your bank reconciliations, there may be a recommendation to come up with some type of control and efforts to segregate duties. We test documentation and support. So if we have account balances reflected on your balance sheet that shows that you have cash of $1 million, we want to validate that against your bank statements to ensure that things are correct. If you are in the supplier industry and you carry large inventory, part of our engagement could be going out to do a physical inventory count. And then we also do not take your word for receivable balances and other assets that may be on your books. That require us to do third-party confirmations that are independent from the firm. So what we would do is go out to your customer through a confirmation letter to confirm contract balances, amounts owed. And then even like if you're a large construction firm, we'll even go out to the job site and talk to the superintendents to ensure that if you have a $10 million project and you're reflecting that you're 30% complete, we want to go out and validate that. Because at the end of the day, we have to render an opinion. And if anything is lent on the renderance of our financial statements and we do not carry out due diligence, we can actually be sued. So, you know, the audit is a lot more expensive and it is the highest level of financial reporting that your firm can issue by hiring a licensed CPA. We'll pause if there's any questions. If not, I'm going to move on.
No questions.
Okay. Corporate financial statements, timely, accurate financial reporting is critical in today's market. I mean, you just can't get by without it. When we look at the different types of financial statements, it's important that you understand the terminology. You know, an income statement, sometimes referred to as a profit and loss statement of income and retained earnings. This report summarizes your income and expenses, and it shows how much money or profits your company made over a specific period. It goes typically 12 months. Most folks are on a calendar year, which is from January 1 to December 31st, but you can have organizations that are on a fiscal year where they may go from July 1 to June 30th, et cetera. Your balance sheet, this report shows the value of your company. It itemizes your assets, your liabilities, and your equity. And it really gives you a snapshot not only over a specific time of your company, but the life of time of your company. And we're going to have some examples of these financial statements, and we're going to go through the different categories. A cash flow statement. A cash flow statement is a financial report that shows incoming and outgoing money during a specific period, often monthly or quarterly. It does not include non-cash items such as depreciation. This makes useful for determining the short-term viability of a company, particularly its ability to pay bills. So a lot of banks and bonding companies rely on this and investors to really see where your cash is coming from. Is it truly coming from operations? Am I heavily leveraged where I got debt? So the company is just doing a lot of borrowing to pay its bills. So it really gives the lender or the investor an idea of your cash flow and how your company is doing. Because at the end of the day, we're all in business to make cash. Personal financial statements, that's important. A lot of small businesses just don't have the history as well as, a small setup business to be able to secure lending on its own. So a lot of times we're forced as a small business to secure or personally guarantee our business debt. And a lot of times we have to present a financial statement, which really on an individual level gives our total assets, liabilities, and just kind of our net worth. And we have an example here. Also, if you're going into partnerships and you're partnering with other folks, it's important if you're going into a business with them that you understand your partner's net worth as well, because sometimes I run into a lot of small businesses that bring on partners, that have partners, and they didn't understand that there may have been credit challenges or negative net worth that can impact their firm's ability to obtain credit. So it's important to understand not only your personal financial statement, but if you have a partner, you guys should understand each other's net worth so that when you're presenting to banks and bonding companies, you're addressing challenges if they exist ahead of time. We're going to go over job and project costing, which is important. It tracks your cost to jobs separately. Accounts receivable aging, just kind of showing you, what your customers owe and the importance of, managing that. Accounts payable aging, that shows who you owe, your vendors, your trade vendors, and, this really impacts your company D&B, and we can talk a little bit about that. And then we already talked about the financial statement levels. Next slide. So here's an example of a balance sheet and just kind of looking at some of the major components. I mean, this is an example of 2019, 2018. Doesn't really, matter the year. I want to make sure you understand the components and the categories. So typically in our current assets section of a balance sheet, you're going to list your financial categories in liquidity order. So cash is the most liquid, your cash and checking accounts. So those would be in your current assets, followed by your accounts receivables. If you're in construction, this is an example of construction. We have other current assets like, costs and access of billings. You can have CDs and other current assets. At the end of the day, the current assets are anything that is maturing within a 12-month period on the financial statements. The next section that's a critical section is understanding your fixed asset section, which is your property and equipment, whether that's property, whether that's computer equipment, any type of asset that you want to amortize over a particular period of time. And it's important to set that up. So, for example, if I buy a vehicle, let's just say for $50,000 or for $50,000, I don't want to expense that to my financial statements exactly, that month. So I purchased it in February for $50,000. I don't want to impact my financial statements, meaning my profit and loss, by the immediate $50,000. What I would do is set up the $50,000 here on my fixed asset schedule, and I would amortize that over 5 years. So instead of hitting my financial statements with $50,000 all at once, which can impact my bottom line, for the first year, if I got that bill in January, really for the first year, I would only be hitting my financial statements by $10,000 on the P&L side. So it's important that you set up your property and equipment properly on the financial statements. This is totally separate from how I reported on the taxes. Under Section 179, if you're a small business, you do have the ability to write off things immediately. And of course, I would want, especially if I'm profitable, I would want to take advantage of those immediate write-offs. That's totally separate, though, from how you report it on books. And a lot of small businesses we get, they just simply use the same method of their tax return depreciation, accelerated depreciation schedules, and they don't go through actually itemizing it long-term on the balance sheet, which is acceptable and will allow you to put, increase your overall bottom line because you're gradually infusing that expense based on the life of the, the asset. Your current liabilities are things like accounts payable, any short-term borrowing, again, anything that's maturing within a 12-month period of the financial statements. You also, long-term debt would be anything that, is longer than 12 months that would be presented here. And then basically you take, in this example, you can see for 2019, you have total assets of $5.1 million compared to the previous year of $5.165 million. And then you have your total liabilities of $3.265 versus $3.9. And basically the equation takes the total assets and subtracts that out, and that's how you get to your equity, or your current liability and equity equals your assets. So in this case, your stockholders' equity is, from a book perspective, if I liquidated this company based on the book value today, the company here in 2019 would be worth $1.8 million, and then in 2018, it would be worth $1.2 million, just to give you an example. And to make sure that your financial statement's balanced, if someone gives you a balance sheet, your total liabilities and stock equity should always equal what your total assets are. So if you're given a financial statement and it has a balance sheet and this doesn't reconcile, then you have every right to ask the accountant or the preparer of the financial statements why it does not reconcile. Next slide. Income statement. So we have a quick example of an income statement here. We show, what our revenue or our sales are for, a particular year. And again, the revenue or sales are those sales or products that are sold that, you're billing to your customer. The cost of sales or the cost of goods would be those costs that's directly related to your sales. So this is an example of a construction. So typically, in order for them to carry out their sales or their contracts to their customer, they would have labor, subcontractor, material, equipment, payroll burden, and other type costs. If I was a supplier or a manufacturer, you may see, my cost of goods where my inventory is moving over to the P&L as I'm getting costs. Labor is a part of most of our direct costs, regardless of the industry we're in. It's really understanding that the cost of goods are those costs that are related directly to my sales. And a lot of times we call that variable costs because that cost fluctuate with your sales. So if I am having 15 million in sales, and last year I had 10 million, one would think that my labor would go up if I have more sales. But if I have a bad year and my sales are down, then I would expect my labor or my material or those things associated with delivering that sale or service or product to the customer would be impacted. So typically, your cost of sales or your cost of goods sold will fluctuate with your revenue number. And it's important as business owners to understand what those profit margins are. So when I look at gross profit margin, I'm referring to what is the percentage of the cost of sales that is related to my revenue. So if I typically run 10.9%, or let's just say I'm talking intelligently to a banker or someone and they ask you, how much do you self-perform? How much do you subcontract? You're able to look at these numbers and talk intelligently and say that I self-perform with my own labor, over 23%, and we only self-perform, 14% of my contractor. If you add all of your burden, you basically can just say that I subcontract out 14% and the rest is done internally. So there's this information is really important for you to understand to help you drive productivity and understand how your business is doing year over year or period over period. Once you get through your gross profit, back to the next slide, please. Once you get through your gross profit, we look at what we call G&A, and those costs are fixed costs. They're typically things that, don't necessarily fluctuate with sales. I have to pay rent regardless. Some folks will allocate some of their officer salary up to cost of sales, but, there is a particular portion of, office sales, whether that's your office clerks or your salespeople that, you will have no matter what, your telephone, legal expenses, accounting expenses. So understanding what your total G&A is and what that represents as it relates to your sales. In this example, for 2019, my G&A represents about 6.81% of my total sales. And then last year of 2018, the previous year in this example, it represented 7.33%. So it's really important that you understand, number one, what kind of revenue that you need to make and profit margins you need to make to cover your G&A. And you can also do break-even analysis and things like that to help you understand what your profit margins and things should be. And if you need to cut overhead, I have a lot of businesses where they're running negative because their overhead is too high. So it's really important that you don't segregate all this cost together. You segregate the cost directly related to your sales in one bucket and then your G&A to another bucket to help you itemize and analyze your business and make adjustments as needed. Next slide. Understanding your cash flow needs. Cash flow is a term that refers to the amount of cash being received and paid by a business during a defined period of time. Sometimes tied to a specific project, measurement of cash flow can be used to evaluate the state or performance of a business or project to determine problems with liquidity. Indirect methods. That's typically what you will see in financial statements. You will typically see, and we'll go over the indirect method. This is the method that most CPAs and is required for your financial statements in GAAP. And that's looking at operational money coming from your operations, money coming from your investment level, and money coming from your finance level. And we'll go over that. A lot of small businesses, though, when we're involved with just helping them project their cash, because a lot of folks don't understand the indirect method. This direct method is what I recommend when you're operational, trying to just understand your cash flow needs as a business. And it's really set up as a checkbook approach. These are the sales or the customers and when I'm expecting the money to come in. So that gives me the total inflows. And then the outflows are the expenses. These are the bills that I have coming up and when they're due. We recommend doing at least plotting it out for 12 weeks. Because I'm going to tell you, there's nothing like being able to plan and know if you have some deficiencies and having time to work on it than being in a situation where you're being told by your accountant that you got to come up with X amount of dollars of payroll and you have no idea how you're going to get it. So it's really important that we do some type of cash flow, and you monitor your cash, especially as you start growing and get into projects, that are larger, that may take a little bit longer to collect, to ensure that you have the resources needed to carry out and execute the project. Payment terms are important as you develop your cash flow needs, and making sure you plot that out and that you understand those needs. If you're in a situation where you're dealing with a customer that holds back retention or retainage, that's important. And then we talked about the break-even analysis. What do I need in order to at least keep the lights on is very important to understand. Next slide. So this is an example of the generally accepted accounting practice, cash flow, and this is typically when you engage a CPA to do your financial statements, and the bank requires the CPA, regardless of the level, compilation, review, or audit, and they want to include a cash flow. This is what it looks like, and I have just a few categories, just not every category, but just so you can understand. So really what we're looking for here, and what you should be looking for as an owner, is positive cash flow from operations. I mean, we're just not in business to have a negative cash flow from operations, but I will tell you that sometimes it happens, right? And sometimes, payments come in slow, so you have to leverage your lines of credit. But this really tells lenders and investors, do you have the ability, if I lend you money, to pay me back based on your operations? So the things that are in a cash flow in the operations section is, first, you typically start with your net profit. And then what you're doing is you're adding back or subtracting out those things that, impact you for the year. So basically, depreciation is really not a cash item. So even though depreciation is included in how you arrive to your net profit, it's added back in because it really is not a cash. It's a generally accepted accounting practice of how you're allocating your fixed assets, but it's not a cash item. So that typically is added back. If I have a difference between one year to the next on accounts receivables, then depending on which way it goes, it's either an add or a subtraction. So example, if the accounts receivable in 2018, just give an example, was $1 million, but then in 2019, it's $1.2 million, that means I'm waiting on $200,000, so that would be subtracted out. If it's the opposite, meaning that the accounts receivable went down from one year to the next, then it means that the net effect is a surplus. So these are the different items that go into your cash flow statement, the operational section. I'm not going to go through all of them. Accounts payable is another one. It's the net difference from year over year. So in this example, you can see in 2018, there was a negative cash flow surplus, so negative from operations. But in 2019, there's a positive, and that happens. So again, the goal, though, is to try to maintain positive cash flow from operations on an annual basis. Excuse me. Another section is capital expenditures. And in that section, that can involve shareholder distributions, that can involve purchases of fixed assets and things like that. The third section of the cash flow is financing. That's debt and how that cash is being used. And you look at that to determine, am I in a situation where the owner is pretty much carrying the business, or is the lender pretty much carrying the business? So that's kind of how we look at the cash flow. And then we look at the bottom line just to see where your cash ended and how quickly, whether your cash is moving up and down, and if you're, able to make the payment. I mean, if my cash flow is 240 at 219, and I'm looking for, a line of credit that requires a $10,000 a month payment based on a cash flow statement, I probably qualify at, given this example. Next slide. Financial ratios are important, and that is a tool that many banks and lenders use. Financial ratios are formed from two or more numbers taken from your financial statements. They are generally used by lenders and bonding companies to aid in determining credit risk and performance. We listed a few of them, 5 common ratios used by lenders, insurance, bonding companies, and others. The first one is your percentage of gross profit, right? I explained to you it's very important to have the different costs segregated, costs directly related to your services or your products. Basically, you would take that gross profit and divide it by the sales, and that's how you get a percentage. So if I had $1 million in sales and my cost of goods, the cost of sales was $800,000, so that gives me $200,000 in profit. If I take that $200,000 and divide it by $1 million, I would have a 20% gross profit. The higher that profit margin, the better. Percentage of net profit margin is important, so I have the growth level, but also looking at all of those expenses, G&A and taxes to understand, what that is. So taking the total cost of goods and admin costs and expenses and seeing what my bottom line percentage is important. You basically take that bottom line number and divide it by sales, and obviously the higher that number, the better. Debt to equity ratio, basically you take the total liability that a company has and you divide it by the shareholders' equity. The lower that ratio, the better. Basically what that ratio tells lenders is that for every piece of equity, that's the dollar amount that I have to cover it. So if I have if that ratio comes out to 2, that means for every dollar of debt that I have double equity to cover it. You don't want to see really anything less than 1 because then that means that you're having a liquidity issue. So it's important. And these are ratios that you can run on your own based on taking your financial statements and going through the exercise. And I always encourage people to understand when you're talking to bonding companies and lenders to understand what their requirements are, what do they like to see, what's a concern, so that you can run these numbers internally and kind of be more proactive than reactive. A current ratio, a lot of banks like to use, that's the higher the better. So instead of taking like your total assets, it just takes your current assets, which is your cash and your AR, and basically you divide that by your current liability. And it's basically just saying for every debt dollar I have, how much cash or current assets do I have to cover it? So the higher, the better. And then the only difference between the asset test ratio and the current ratio is a lot of suppliers and manufacturers, they carry a lot of inventory, and a lot of times bankers would like to subtract out the inventory because they're not necessarily interested in turning your inventory. So those are some key ratios to understand. You can certainly take these and apply these to your financial statements. You can call up Ringgold and we can take your financial statements and perform an analysis and give you feedback and come up with maybe some strategies and efforts to help you get those ratios up. Next slide. A personal financial statement, as I indicated, is important because a lot of times small businesses just can't get the lending or the bonding needs that they need just on their business alone. They have to personally guarantee it. Bonding companies, lenders, and most equity investors want to know not only about your business financial position, but also about the personal financial profile of each business owner. SBA has a general personal financial template that you can use. Usually your bank or bonding company have their templates, but if you just want to go to the SBA.gov, SBA forms, you can get those forms so you can see how, what's required. We have a simple example later in the presentation. I think it's the next slide that we'll go over. It's important to keep your personal financial statements updated at least on a quarterly basis is what our recommendation is. You want to make sure your personal financial statement is accurate. A lot of times we look at tax returns and other things, and we look at your financial statements, your tax returns show that you've received X amount of dollars in dividends, but then when we look at your personal financial statement, you don't have those investments listed. Or, your tax return shows that you have a tax debt and maybe that tax debt had not been paid and, you don't have it listed. Or your mortgage statement for a property that you own may show X amount of dollars on the statement, but it doesn't correspond. So it's important that, the financial statements are kept up to date and that they reconcile to source documents. Personal credit score, establishing and building your credit is very important. Making sure that, we do offer credit restoration services where we can look at your credit report to see if there's strategies and efforts to improve your credit. We also give a credit restoration seminar that is very helpful in helping you build your credit and maintaining your credit. Your D&B credit rating is very important. A lot of business owners don't manage it. And I'm not saying that you have to. I know when you sign up for D&B, they hit you with all these promotions of all the other services that they offer, which, most of us don't really need those services. But it is important because unlike a personal credit, lenders and vendors, they don't have to report on your personal credit report. So a lot of time, on your business credit report, obviously on your personal credit report, they does. So a lot of times, if you're doing really well in paying your vendors, you don't really get the credit. The only time you see a D&B hit on your account is when it's negative. But you have every right, and you can actually build your personal credit score by actually reaching out to those vendors that you pay on time and ask them to report prompt payments on your D&B. This is a very common strategy that can be used for small business owners to help boost their D&B credit rating. Next slide. So this is just a quick, simple example of what a personal net worth statement looks like and the components that is included. Your assets would include any cash or banks that you hold, any real estate that you have. Now, if you're doing certification, with different agencies, you get to back out your personal residence. But, from a banking or lending perspective, I encourage you to put all of your assets, whether personally or not, as it relates to real estate on it if you're trying to obtain a loan. Your personal property, if you own vehicles or art or jewelry, cash value on your life insurance policies, if you have any 401k investments or deferred payment investments. And there's others, but I just wanted to give an example of the type of assets that should go on this statement. In this example, you can see the total assets for this individual is $1.022 million in assets. And then you just simply add up all your liabilities, everybody that I owe, accounts payables, balances on mortgages or loans, tax debt, anything that you have, you add all of that up. In this case, it's $255,000. You subtract that from the total assets, and that's how you get your net worth. So it's important to, go through this analysis and keep it updated so that you're not scrambling when you're applying for loans, applying for banking, and then even for your certifications, there's templates out there that annually you have to, update or not, depends on the agency. Next slide. Corporate taxes. It is so important that you hire an accountant that really understands your industry. It is important to file your taxes accurately and timely, and usually lenders and investors want to see at least the last 3 years of your tax return. I already stated you need to hire a tax accountant and understand your industry. If you're in construction, that's important to understand if you're on accrual versus cash, understanding that if I'm on percentage of completion or completed basis and taking advantage of that. If I have customers that pay retention or retainage, understanding the rules and how I may be able to back that out. profitability on projects. If I'm a construction firm and I'm on a percentage of completion, I may be able to be eligible to defer jobs that are not 90% or better. Just really understanding the rules, understanding the Section 179 rules. If I'm a supplier, understanding how inventory is handled. Even from when you start your entity, if you're a new business, hiring an attorney that, you can talk to about, is it better to have an LLC versus a C Corp and an S Corp? Just really understanding the setup from the beginning is very helpful as you plan. Determining if you should be on a cash basis versus an accrual basis versus a completed method. Those are different methods. There's different methods of tax reporting, and depending on your type of business and your activities, one may be better than the other for you. A lot of times cash method is always considered the best, and a lot of times it is the best. But some businesses that carry inventory are not required or they're not allowed to be on a cash basis. Or if your revenue is, I guess under Trump rules, they did increase it by $75 million, which is great. But, if your business is a certain level, you may not be on a cash basis. So really understanding, from a tax method, what works best for you. But then you have some businesses that carry a lot of liability, a lot of payroll opposed to their AR, and the cash basis may not always be the best. So having that determination is, and someone that's qualified to make that analysis for you is important. Make sure your accountant provides you a copy of the important work papers, like a detailed fixed asset, a book to tax reconciliation, shareholders basis schedule. I can't tell you how many firms we pick up as new tax clients and they don't have these documents, and then they have a tough time getting it from their CPA. So we are only required to submit certain documents with your tax return. So the detailed fixed asset schedules, the book to tax reconciliations, and shareholder basis schedules, they are documents that, are part of your tax work papers. And if you're ever audited or challenged, we need that information. Or if you choose to move and select a new accountant, they need that information to set up the beginning balances. So it's important that you make sure you have those things in your possession and not just a copy of your tax return, but ask the tax preparer for your tax work papers so that you can store them in the event that you need them. It's also to understand that, a company that is profitable must pay taxes. The objective is to plan for this debt and pay only when you are required to pay and only what you are required to pay. So, and what I mean by that and why I have to state that is every year it never fails. I get the client that don't want to pay any taxes, but yet he's trying to get a $5 million line of credit or a $100 million bonding. Well, if your company does not show profitability, it's very difficult to do that. So I know a lot of small businesses, objective is to, try to minimize, and that should be your objective. But at the end of the day, if you're profitable, there are taxes that have to be paid. But our job is to just make sure that we take advantage of the tax laws, we maximize the tax laws. So number one, that the taxes are minimized and you're taking advantage of credits and deductions that you're eligible for. And then also that you only pay when you have to pay. So if there's an opportunity to defer taxes or do any type of planning like that, that's our job. But just want to leave this note with saying that if you're profitable, at some point you do have to pay taxes, and you do want to show that your entity is profitable in order to help you get loans and bonding and things like that. Next slide. I'll take a pause. And if there's no questions, I'll go into. So I think this came out of the Cranes. They did a little article of, failure and why businesses, fail, and, us doing certification or assisting with certification for so many years with the city of Chicago and just supporting other, entities and really just understanding, you know, the level of businesses and how many are really, you know, profitable, how many are really staying in business, and just trying to understand the reasoning for, you know, failure for some of these businesses. And this is the way they were listed. So the first one is unrealistic growth or change in the scope of the business, which represented 37%. So changes in the type of work performed, if you're doing work that you're not necessarily skilled to do, could be a challenge for you. Growing, very increased growth. You can have someone, a perfect example, that now they're in the MBE program. They were doing maybe a $500,000 firm. Now they're getting contracts that are $1.5 million, $2 million, and they just really didn't plan for the growth, and things start to fall apart. So growing too fast is really can be dangerous, and you need to plan for it and make sure you have the people and the resources to support the growth. Performance issues. I mean, no one can do everything, so it's important that you perform and do the work that you're experienced at. And if you don't have the experience, that you hire and develop the right personnel to carry out the work. Management and personnel issues, changes in leadership that happens all the time, where, you know, changes in leadership might equate to maybe that you're losing a substantial contract. Accounting issues. I mean, information dictates behavior. So not getting information timely and adequately can really cause some issues, and you can wind up thinking you're doing better than you are, or not identifying a potential issue early enough to get it resolved. And then there's other factors, you know, your inability to pay or the inability to be paid, you know, understanding and really getting ahead of your contract terms and making sure you understand the contract terms, and so being selective on who you work with, because every customer is not a good customer, especially if they don't pay you on time. So those are 5 examples of failure, and that what was reported in the business claim. Next slide. So accounting and business tips. The first thing I can say is that you need to be a good vendor, a good contractor, service provider first. Be good at what you do. Find an accountant and an attorney, I should have here, really, and a banker that really understands your industry and supports you. Set up your accounting and your reporting systems right from the very beginning. Having good budgeting and planning is very important. If you're in a project that you're estimating, it needs to be accurate. It needs to be competitive. You need to make sure that you're getting all the components in. I can't tell you how many clients we look at their pricing and their job costing and discover that they're not including all the costs and not passing that cost to their client. Or they're not taking in consideration, if you're in, like, for example, the construction industry or trucking industry, and you know that your insurance rates are going to be going up because maybe you had, you know, some accidents or things like that. Making sure that you're ahead of that and keeping that, and making sure that that estimate flows into your rates to your customer is very important. Seeking legal advice, understanding your rights, understanding, you know, if I'm in a project where I'm not being paid, what are my lien rights? You know, what are the stages? Making sure that I get the information up front, not when I have a problem, now I'm searching for it, but getting that information up front and having legal counsel in place. Even if you're doing subcontracting, making sure those contracts are in compliance with what you're required. Making sure you have the proper insurance coverage. Can't tell you how many clients we get that they're in the wrong classification and they don't have the proper insurance coverage. Making sure that you are managing your jobs and that you have the tools to give you the information to manage your projects properly. You want to develop good partnerships and joint venture agreements and continuing to network and come up with innovative creativity. I mean, these times have been different. I tell you that with COVID, it's really changed a lot in our business and many of our clients' business on the way we do business, and we've had to be very creative and implement best practices. Next slide. With that, if there's no questions, I'll pause for a minute, and then I know that I'll take it back to Olga so she can talk about some available resources.
So if anybody has any questions, please feel free to enter them in the QA or go ahead and unmute yourself and ask the questions. I really recommend if you have questions, don't stay quiet. We have a CPA with so much experience, so much knowledge, so take advantage.
Olga, either I was very boring or I answered everybody's questions. So,
I have a question.
Sure.
So I know for partnerships for LLCs, the tax preparations, the tax basis, let's say it's cash basis, right? And the stockholders' equities, that's being recorded on cash basis. If we have our books on accrual basis, do we still have to convert the stockholders' equity to the cash basis, or we just keep it all accrual? And I'm specifically talking about LLC partnership.
yeah, I understand. Yeah, so basically, on an accrual basis for your financial statements, you definitely want to present, on a GAAP basis. That's considered best practices accrual basis. I don't know if you remember in the part of the presentation where I was talking about a cash basis. But from a tax perspective, if you're eligible for cash basis, then yes, you would convert those financial statements to a cash basis. There's a couple different ways that your tax preparer can do it. They can do it as an offline adjustment, or they can do it right on your tax return. If you're an LLC, you're reporting on a 1065. If you're a multiple owner LLC, and there's a section on your tax return called an M2 adjustment, and it's really a book to tax adjustment where it bags out that information. So to answer the question, accrual basis for books, and then I would recommend, if you qualify and cash basis is best for you, to be on a cash basis for tax purposes, and that can be handled directly on your tax return in the M2 section of the 1065, or your CPA or accountant can do it offline.
Okay. So I don't have to adjust our, retainers or stockholders' equity for any distributions or contributions on a cash basis, as it will be done for tax purposes, right? So those are kind of, I have to keep those separately, really.
Yeah. So from what are you using, QuickBooks?
No, it's Deltek.
Okay, so I'm not familiar with that software, but some software does have the ability to run the financial statements on an accrual basis as well as a cash basis. So, I mean, it's not something, if you're using an accounting software, you can definitely give your accountant the cash basis and the accrual based financial statement. For those folks that our clients where we don't, they don't have that ability, and quite frankly, depending on how complex your financial statement is, QuickBooks doesn't necessarily do the best job of converting. You should really be able to give that to your accountant, and they can do the conversion for you, because after all, they're the tax professionals. They understand the code and what is allowed and what's not. So that would be my recommendation.
Okay, thank you.
Thank you.
Anyone else with questions? If no one has any questions, we'll move on. Just a reminder, if you do have any questions, if you think of a question later, my email is in the chat. You can go ahead and reach me, and we can set up a meeting to discuss. If you have any questions, set up a meeting with Michelle. If you're I.DBE and it's covered under the management services, we're happy to help. So keep that in mind. So we'll go over the available resources. So events and workshops. So the Building Blocks of Success workshops, it'll continue through April 2024, and you can register at Eventbrite. You can follow that link, scan the QR code, or go on the link and sign up. The next workshop is on Thursday, and it will be budgeting, cash flow management, and Ringgold will also be presenting. It's a great informational workshop, so we welcome you to attend also and sign up. So make sure you sign up for Thursday, same time. And again, we have these are a list of our February workshops. As we said, Thursday is budgeting and cash flow management. And you can also ask questions before the workshops, and just at the bottom, there's a link where you can ask any questions you may have prior to the presentation. And then, so to submit the questions in advance, you can visit the link there or scan the QR code, and it'll take you directly to this page where it's a questionnaire. You complete the questionnaire, and then before as the presentation is going on, we can go ahead and answer those questions. Workshops and webinars, you can visit the Illinois Department of Transportation YouTube channel. The channel is youtube.com/@illinois. You're going to have to go into the playlists as shown here and go into the consultant YouTube playlist. Here's a direct link, and all of these presentations, workshops that we've had in the past and today's will eventually be on there. So you can go on this website and view any past presentations, any that we've had, any topics that you may be interested in. You can go ahead and visit the YouTube channel and watch them here. So you can scan the QR code or click the link on the chat to provide feedback about the session. So as a reminder, we will send a following email with the recording of the event, the presentations, any links or resources and programs, and then upcoming workshops and events, contact information for OBWD staff, consultants, and contract compliance officers. So with that, we'd like to thank you for attending today's workshop, and we look forward to seeing you or hearing you Thursday at our budgeting and cash flow management workshop.
Thank you, Olga, and I'd like to thank everyone for their attendance. We really appreciate it and look forward to seeing you at the next workshop.
Thank you, Michelle. Thank you, Olga. And those of you in attendance, you should be receiving something from me either later today or tomorrow with the details from this workshop. Have a good day.
Thank you.
Thank you, Brian.